I've been thinking about what risks are out there today, because 12 years ago, it was so easy to identify. That the subprime mortgage market was unique, it was individual, it was an idiosyncratic being that you knew could cause a crisis. You had no idea it was going to land in Iceland. You had no idea that systemic risk would take hold where it would go, but you could identify it. It was one thing. And today, it's not one thing that you can say, that's it, I can pinpoint it. But we know that since the crisis ended, that the incremental debt build in the world has been of equal magnitude, and that this great experiment on the part of central banks has occurred at the same time. Something unprecedented in our world's history that now amounts to $22 trillion and counting on central bank balance sheets. It's a huge figure. It's hard to imagine how big of a figure it is, but it's not the only story. So I said, where is the debt coming from? And the debt is coming from the capital markets, from bonds. It's coming from emerging markets, from frontier markets that I can't pronounce, that are able to issue bonds. And it's coming from the central banks. So when you add up the shadow banking system, what's happened in the capital markets, and the central banks, you get to this $71 trillion figure that dwarfs the size of what the subprime mortgage market was. I think that the spark, obviously in February, investors here in the United States had a great scare, and volatility picked up after 2017 being basically in a comatose state in the stock market. And it really got all of our collective attention. And so volatility was the big buzzword. I'm actually following the volatility that's still very calm, the credit markets. And if you look at volatility in the U.S. Treasury market, which is the deepest and most liquid bond market in the world, it's at a 50-year low right now. So we may have seen the initial rumblings, but I think we're looking at the order incorrectly. I think we need to look for volatility in the credit market, and that will really spark volatility in the stock market. And to answer your question, it will not be kind to your 401k at all.